Hello and welcome to Damien's latest Midweek Markets podcast, a podcast where I talk about what's been going on in investment markets and what will happen in the weeks to come. Now, this week has been an incredible week in investment markets. We had a period of 2 weeks where nothing seemed to happen and we just went sideways. But now in the last week, we've had a real seesaw, a whipsaw, where the market actually sold off and has now rebounded. Now, if you look at your stock market app, get it out on your phone, and if you have a quick look, go back the last week, you will see that we got towards the 2,800 level on the S&P 500. And then that's been a level of resistance we've been at now for about 2 weeks, but it's been tested about 3 times previously after the sell-off in October. We got back to that level and then we had a violent reaction and we sold off. And now the catalyst for that was concerns over global growth. So we had a slowdown in exports in China, a 20% fall in the exports in China, which is it's an incredible number. It's massive. It's almost inconceivable, really. And we had other evidence of slowdown in the US economy, for example. There was a jobs report on Friday which seemed to re-emphasize the fact that the US economy might be slowing down. But then what we saw was the market pull back, and the pullback was slow and steady. We had it day by day, only very small amounts. You can see it on your app if you have a look. But then it started to unwind much faster. And we didn't have a collapse. You see headlines saying the market collapsed. We didn't. What actually happened is we had a slow, steady fall and we got down to about 2775, which was only about 40 points below where we were on the S&P 500. But it's a critical level. Then we started to unwind a bit more. We dipped down below levels that we hadn't seen for a couple of weeks, and that was very negative. Now, what you see in markets, we have this idea of, it's almost like a fractal. So if you get a snowflake, I don't even remember this as a kid, they used to tell you get a snowflake, you zoom in on a part of it and the pattern repeats, and you can keep going on forever and it repeats and repeats. You get that in investment markets. So if you look on a daily basis, you get this idea of things moving up and down very quickly, and it's very erratic. If you zoom out and just look on a weekly basis, so you just look at the weekly change of investment markets. On the S&P 500, what we had at the end of last week was a position where the market had actually fallen much further than the place it was the previous week. They call it a bearish candle. I'll come on to candles and things probably in a future podcast. But what it meant is that the market had pulled back, but in a very steady and very negative way, which was a bearish sign. So everybody thought the market would collapse this week. Now, we're not out of the woods yet, because what we found this week is the market has rallied. We've actually gone back and regained all of that downside, and we're back up against that resistance level, and we're trying to test it. Now, some of that was just pure optimism, just the bulls buying the market, and of course the central banks globally have been very dovish, and they've decided they're going to actually launch new equivalents of not quite QE but very accommodative policy. So last week we had the European Central Bank relaunch an old piece of monetary policy to help boost lending and liquidity in the banking system. That was launched, and of course that was initially met with some optimism. Very oddly, I'll come on to it in a minute, but very oddly it was actually then turned negative. We saw some more liquidity injections and tax cuts in China, so people are starting to buy the dip. And in the last 10 years, buying a dip has been very positive. And it's funny that this week was the 10th anniversary of when we first ever had the QE, the quantitative easing after the financial crisis. So what did we learn over the last 10 years? Well, it was to buy every dip. At the end of 2018, if you look at your apps, doesn't matter which stock market you pick, the market's sold off. And that was because the Fed and other central banks started to tighten monetary policy, or at least talk about it. So the market panicked. So you didn't buy the dips, you sold the rips. So basically when the market went up, you sold out. And we've now got back into the period very quickly where buying the dips seems to work. But there is this element in markets that they're not quite convinced, because when the central bank decided to launch their new liquidity measures, it was a bit of a panic of what do they know that we don't. And the numbers coming out of Europe have been pretty scary in terms of economics. And so we're at the point now where we're thinking, is it really that there's a lot going to go wrong? There's actually we're still in a bear market. that is yet to be determined. Now, one thing to have a look at, we talk about moving averages, and if you listen to this podcast, I've talked about the 200 moving day average, and it's quite a key one some people look at. I don't tend to focus on it too much, but generally speaking, if any stock market, whether it's the FTSE 100, whether it's the S&P 500, is above its 200-day moving average, which is the average of the prices over the last 200 days, if the market today is above that level, that's seen to be bullish. If it's below it, it tends to be bearish. At the moment in America, which America is always, we do focus on it a lot because it tends to lead the sentiment globally and it tends to lead other stock markets. We're at the point where the S&P 500 broke below that level, and that was when we got that really bearish move and bearish candle, and we're suddenly thinking, could things unwind? 2,700 remains a key level to look at on your app, but the VIX also popped. So the VIX is the fear index we have on the S&P 500. It's a good measure of fear. But what we then got was the market bounced back above it. And I quite like the 200-day moving average at the moment, although I don't place a lot of importance on it. Some traders do, particularly day traders, because I look at things from the long term. So it's still interesting as a general indicator. But what we've got at the moment is a 200-day moving average, which is very flat. So if you look at a 200-day moving average chart, just Google it, you'll find one. So pick the S&P 500, for example, and say the 200-day moving average. You will find a chart out there that shows you that it normally goes up and down, but it's got to the point now it's very, very flat, and it's almost like an adage where if the 200-day moving average is very flat, then the market tends to flip-flop either side, and it's very difficult to determine whether the market's going to break higher or lower, and some traders just steer clear, and we're talking short-term traders here. But what that means for longer-term traders is it's probably unwise to place bets just yet on whether the market's going to break higher or lower. Now, as I record this podcast, the market's again bumping up against the resistance level, so we still aren't sure. The US trade talks still seem to be trundling on. We don't seem to have any resolution at all. That's going to be key. We've also had some bullish activity in the oil market. Oil is seemingly in a bullish trend, and until recently has had a lot of influence on the equity market. So if you listen to the earlier podcasts in this show, you would have heard me talk about oil and its impact on the equity market. I couldn't finish this podcast without talking about Brexit. Now, anybody who's been following this podcast will have the pound dollar or the pound euro exchange rate on their app. Now, Brexit is at the moment a complete shambles, complete chaos, and if you're going to try and bet which way Brexit's going to go, you're probably going to come unstuck. And if you want to see that in action, look at the volatility, the ups and downs you've got on the pound dollar or the pound euro exchange rate. And actually today the pound has strengthened, because the reason it's strengthening is we're looking more and more likely that we may delay Brexit, or Brexit may go into the hands of the Houses of Parliament rather than Theresa May and her government to determine what we do and where we go, which increases the chance we might never leave, or a second referendum. And therefore that is going to be good for the UK economy if we don't leave. There's going to be some sort of chaos, and therefore is good for the pound. And the pound is just a measure, if you want to think of it in one way, the strength of it is a measure of confidence in the UK economy. So as an investor, what you're going to find is when you look at your portfolios within the next week, 2 weeks, 3 weeks, that whatever the market does, whether it's going up or down, your portfolio could be doing something very different at that time, and you may not understand why that is, and it's probably going to be because of the currency exchange rate. So any assets held overseas, if the pound strengthens, will be worth less. If the pound falls, no matter what they do overseas, so even if the market goes down, it's likely to get a boost from that dip in the value of the pound against that particular currency. So there's so much going on at the moment in markets that they've actually got exciting. So although the last 2 weeks we had nothing really going and we're bobbling along, this week we had a big dip and then a rally. And so where we're going to go next, I mean, who knows? And it'll be exciting to see that in the coming weeks. We're going to see still lots of talk from central banks about global growth. That is, I think, par for the course. But for investors, you're going to learn so much in a very short space of time, because when we get these wild swings, you start to see the interactions between different stock markets. So that's it this week for the Midweek Markets podcast. Make sure you tune in next week. If you've got any questions, then do email me at Damien@moneytothemasses.com. Please share this podcast on social media. Tell everybody about it. I know there's been a lot of you that have been sharing the podcast on Twitter and Facebook and Instagram, and it's made a big difference to all the downloads we have, so thank you. So please keep doing it, and until next week. But what we had was, you two just really put me off there. I've lost my trail of thought.